Drew Meredith, how you doing?
Very, very well.
What's news in the world?
I don't know, a little bit confused about where you're coming from today. I was, trawling YouTube late last night, like a lot of us do. And then I thought it was a fake background you might have had when you were doing your recording for the Australian Finance Podcast. But no, alas, it is live.
Oh, yeah, that
again.
went live. Yeah, I was recording live from Dog on a Tucker Box yesterday.
Yeah. There is a reason. You're a Gunda guy.
Yeah, for those of you that don't know Dog on a Tucker Box, like where the bloody hell are you, is what I'm saying. Dog on a Tucker Box exists between Canberra, Melbourne, Sydney, somewhere in that range. It's called Gunda Guy.
Mark of Melbourne to Sydney.
Yeah, and they've got some good electric vehicle chargers. Unless you have a Kia or some other device that can't charge on a Tesla supercharger, because I ran into a few innocent civilians yesterday that decided to go the other EV route and ended up getting stuck at the chargers because the other chargers wouldn't release their electric vehicle. So that was fun. But we just
really want to stay. How was the food? Whelming, overwhelming, underwhelming?
On the way back from Canberra this morning, I stopped in Holbrook, which is a wonderful small town just in New South Wales there. Had a very good big breakfast. Here's a bit of a question for you, Drew. We've got a lot of questions to get to today, but here's my question to you, the most pressing of the day. How much is too much to pay for a big breakfast?
Oh, I feel like anything over $26 if you live in Melbourne.
Yeah, see, this is the thing. I paid $29 in a regional town. I was thinking, It did say that they had Holbrook eggs. So I was willing to pay a little bit extra. It's on the business account, mind you, as well. I was willing to pay a little bit extra to get the local eggs.
$29 big breakfast.
Yeah. It doesn't matter what it is.
I guess that's a real question. Was the breakfast big?
It was medium.
It was medium.
Yeah.
Again, cost of living, inflation.
Well, in their defense, they didn't call it a big breakfast. They called it a full breakfast.
So 2 eggs, baked beans, sausages.
No baked beans. Yeah, this is the thing. It was a medium size. So there's no. Anyway, we're off track here. Not a great investment. Probably not good for your heart either. But here we are on the Australian Investors Podcast, coming to you live from somewhere in regional New South Wales. Drew is in the studio in Melbourne. Yes, turns out if you do have an electric vehicle, one of the convenient things is you can charge literally anything from your electric vehicle. So it's basically just a battery on wheels. So I'm able to effectively live in this thing.
Interesting. Is that the old cigarette lighter that you have to plug into, or is it actually a power plug you can put into?
Let's just say Tesla would be bankrupt if they put a cigarette charger in one of their cars. I think that's the wrong demographic for a Tesla.
The Prado in the back, it actually had the normal 3-prong. I was like, it's got a normal power thing, because you just so used to, like, even if you're going camping, the pumps that you buy, they're all like, they have to go in a cigarette thing. I'm like, I didn't know didn't know we still need to plug into these. I thought there was another way to do it.
I feel like that's just backwards compatibility. I feel like in the next Prado that won't exist anymore. But yeah, no, these are just like Thunderbolt charging ports everywhere in the vehicle. And some of the BYDs actually have, just like the standard, like a power point that you'd have at home, and you can charge your tools if you're a tradie and stuff like that, which is really cool. But there's been a lot of news out this week in big tech, in particular NVIDIA overnight, which you're relishing because your portfolio is up. Of the $10,000 portfolios that we've got, the Honourable Drew Meredith is leading the pack. Over 1% in the black or green, depending how you think about it, for the year. I'm actually near break even, Drew.
Tesla's on its way too.
You are sending it indeed. And the community portfolio has dipped back slightly into negativity, but there's Vulcan and some other mumbo jumbo in there that are just like speckies from the community. So lots of good stocks, lots of good ETFs in there. I do feel like on the home straight, the GGUS ETF towards the back end of this year, not a short-term trader, but if I was, let's do it over 2 times leveraged. Yeah. For every $1 that your Tesla goes up, for every $1 that your
mine gets more NVIDIA you actually think that's leveraged? This is more leveraged.
We are on, baby. So it's going to be interesting. It's going to be interesting. We're starting to feel like we're actually professionals now with the portfolios back to break even.
We're not losing any more clients because of poor stock tips anymore.
So one of the things that we did promise last week, though, Drew, is an absolute mozza of questions. So
no golf talk, yeah.
No golf talk, no laughing from Drew, absolutely zero laughing. So we do have a lot of questions. I might start Actually, you've got some news. Wasn't there some news from Tencent just quickly? Was it Tencent?
No, that was from last week. NVIDIA was the big one overnight. It might have been overnight. But they delivered another, I think this was a 10th straight record quarter of revenue growth. Up 69% from 12 months ago. So despite
69% revenue growth, yep.
They're saying like an $8 billion hit from Trump's ban on Chinese imports of NVIDIA chips. But the company still beat consensus.
Still, in the quarter alone, it was $4.5 billion of impairment charges and like write-backs basically because they had all the orders from China that they have to refund and all that sort of stuff. So $4.5 billion just in the quarter. So that's a big deal. 70
data center revenue, $40 billion, up 73% from 12 months ago. Like there's just the scale on this is just crazy and it keeps going. I think it's about to overtake Microsoft as the biggest company again. Yeah. $19 billion of net income in the quarter. That's in US dollars, so not the Australian pesos. So that is a real business operating at scale, just quite unbelievable. If you had excluded the impact of the H20 chip GPU charges, effectively it's 73% in the profit margin. So that is insane when you think about that. Like that is... It was a few short years ago too.
The inflection point on this, shout out to David Gardner from the Motley Fool in the US who's held this thing over 20 years. And
you said Munro were topping up last quarter as well, apparently.
Interesting.
I saw that in the paper this morning.
I think I could be wrong about this, but I'm pretty sure David's per share, like unit cost on NVIDIA is something like $1 or less.
Did they have
I think it may even be less. I think it may be like, I think it may be 30 cents. So incredible. Now that's $139 a pop. So wonderful business on fire. So as I mentioned, there's a lot of questions for us to get to, Drew. In particular, lots of questions about stocks, about ETFs, some recent changes as well. So please write in your questions via the link in your podcast player, or if you're on YouTube, you can just drop that below the video. Again, where it says ask a question, select the Australian Investors Podcast. We welcome banter. We welcome questions. We welcome jokes and feedback. We also just general heckling is okay in there too. Please use a funny name.
And feel free to put those questions on Owen's windscreen while he's charging his EV on the way back from Melbourne if you run into him.
The first question, Drew, comes from More Than Homes and Holes. And the question is, Owen, you spoke recently about using ATEC to diversify your Australian allocation. So for people who don't know, ATEC is the ETF from Beta Shares. ATEC is the ticker symbol. I've recently considered the same issue of large cap and sector concentration on the ASX. And my answer was tilting an allocation to MVE, which is a Van Eck Mid-Cap Index ETF, Solpats, which is SOL, and an unlisted active small cap fund or funds. Despite the losing winners and gaining losers effect of a smaller cap ETF, the historical outperformance of the ASX mid-cap is clear. If evening out your sector exposure is the objective, why not OZXX, which is an ETF from Globalex, sponsor of the show, the ETF that only excludes financial/REITs and mining/energy, keeping a broader exposure at a lower MER that doesn't have the concentration and volatility of ATEC. Is this a personal active view of yours to choose an allocation expecting outperformance? Okay, so there's a lot in this question. Maybe just generally, Drew, I'll start with a question to you, is do you use like small cap and mid cap style investments in your portfolios at Waddle? And like these could be ETFs, active funds, like just how do you cut that up?
So we have two types of investment strategies. Both are kind of the same broader philosophy, but we have a core and a core satellite, if that makes sense. So we have an ETF only model that is kind of the basis of where everything comes from. And the ETF only means basically it's index only. It's index, everything in there is index tracking. And that does have a small mid-cap exposure in there, like the X20, which is kind of, X20 is still kind of large mid-cap. But we do have a dedicated exposure there. And we give people two options. That's a very low cost, index driven. And yes, I think we always have an exposure to small and medium-sized companies, given the history, not necessarily of outperforming in terms of share price returns, but in earnings growth and the growth of the business, because obviously share price returns can just depend on when you're measuring it, as opposed to anything else. And then in our active, so our core satellite, which is a higher investment cost, we naturally prefer to use active managers, given the history of outperforming in those parts of the market as well. I think one thing I'm always wary of is so when you introduce things like you have with tech, like OZXX, are you then introducing new biases or concentrations that you're not aware of? That's always the big question that I'm always asking a lot and that we're talking about a lot.
So what would be an example of that?
You'd have to look at the underlying holdings of OZXX. So are you then overexposing yourself to another sector or another large holdings like in industrials or so always being wary. Same as like tech, you're overexposing yourself to 2-3 tech companies because everything you add has the potential to tilt and bias away. And there's always the high level question is, are you comfortable with the average, with the index? And yeah, sure, just don't worry about evening out your sector weightings. I think that's what this question's about too. But if you're worried about evening it out, then yeah, let's start looking at tools and finding the right ones. But OZXX, for instance, you've got it's just as concentrated as anything. It's 11% in Wesfarmers, 10% in CSL, 6% in Telstra. So you're now increasing your weighting to already large parts of the rest of your portfolio and potentially to other sectors. So you could be inadvertently adding to an overweighting to discretionary or retail that you don't necessarily want as well. I think that
that makes sense.
One key is always you want to smooth the volatility, but you don't want to get rid of all the potential growth, if that makes sense.
Yeah. I think one of the things that makes sense to me, so what they're referring to with the losing winners and the gaining losers idea is something that I spoke about recently on a live show, which is just that when you have one of those ETFs that says, I'll just take the midsection, please. So not like in a traditional index fund where you've got the large caps, BHP, CBA, Apple, NVIDIA at the top of the ETF and the biggest part of it. If you just go the mid cap one, what can happen is you don't get all the smaller companies going in until they're already grown a bit. And on the way out, you lose them if they go on to be like the next blue chips. So you're kind of capturing them in this moment in time, which could be a few years, it could be a decade, maybe unlikely, but it's going to be in that period. At the same time, you've kind of got these other companies falling from grace down through that mid-cap index. It's undeniable that MVE as an ETF is very good. I think it's one of the kind of really unique ones. I think it holds 50 stocks off the top of my head. It's in that mid-cap basket. It's not overly complicated. And I think this would have come from Van Eck as a result of a lot of financial advisors saying, hey, a lot of our clients like the banks. They like CSL. They like those types of things, supermarkets. We need something that's not so crazy that it's going to be really volatile, but we want something that's in the middle there just to complement their portfolio and blend it a little bit. Now, for me, when we make decisions in our portfolios, unfortunately, given the nature of our business and compliance and licensing and rules and these types of things, I mean, who needs rules? Let's be honest. But as we've now gone into that world, I just can't make decisions willy-nilly. I have to put it before an investment committee for certain positioning and these types of things. And I did put to them OZXX as one of my preferred plays. So this is an ETF that just goes basically the ASX minus banks and resources, which makes a lot of sense for a lot of people that have banks and resources in their active portfolios, their index portfolios, or even in their shareholdings. The problem with it is, and the reason I couldn't get it past an investment committee, and it's fair enough, is that the ETF only has about $4 or $5 million inside of it. And there's another question on this, I think, today. But what that basically means is that if then we go and invest in it and the ETF is not viable for the ETF provider, then it may be closed down. And that may artificially cause tax events for our community and something that we take very seriously. So for me personally, I would happily allocate to something like that, knowing that that was the risk. But when you're at scale and you're trying to invest other people's money, it's not always a good idea to take a risk on something like that. for what it's worth, I think the ATEC ETF and the comment about volatility, it is kind of like an active bet because we are just zooming in on technology and software. That we want, I have this kind of, maybe it's like, I don't know, Drew, I'm curious if you agree with me on this or not. I have this view that like an index fund, it just buys companies, whatever's in that marketplace. And so if we think about what ATEC does, it just buys technology companies, software companies, cloud companies, SaaS companies. And if you think about like what are the future facing industries of Australia, it's this industry, in my opinion. Like this healthcare, banks do a great job, don't get me wrong, but like if you wanted to take a 10-year view, wouldn't it make sense that you would have a sizable bet on companies that are growing faster, have higher returns on equity, higher returns on capital, bigger gross margins? Yes. Like you could go and buy the stocks yourself, but this seems like a pretty innocuous, pretty sensible way to play that decade-long thematic in my view. But I'm happy to be shot down, obviously. I'm curious to know what you would think of that.
No, I think it's a really good tool. And I think all these, like, I think the key here is that it's not thematic, if that makes sense. There's always concerns about something being thematic, and as you said, if usually in my experience, if a ETF doesn't raise enough money within like 3 years or so, they tend to close down, as you were saying. And this isn't a thematic. This is something that you can actually use as a tool within a long-term portfolio. It's not something that'll trend in and trend out. Yes, it'll perform like it's tech, so it'll get momentum. And I think but the basic rules we always have is that you need to find growth in a portfolio. Most people don't have the benefit of being able to just put all their money into a term deposit and generate enough income regardless of what interest rates are doing for the rest of their life. So everyone needs growth. And you're not going to see, you'll see, PE expansion for the banking sector and the traditional sectors because they're all cyclical, but that's in swings and roundabouts. This is where you get real earnings growth, and it's in the tech sector. The question I always have is, if we compare, the top 3 companies probably, maybe the top 4 out of the top 5 are incredible global companies, but then the others within Australian tech tend to be a bit more domestically focused, and that's why we've always had this Australia for value, overseas for growth, and always preferred the NVIDIAs, the Apples for our larger tech exposures, if that makes sense. So from a total portfolio level, looking at making sure we've got enough tech exposure as opposed to just looking at as what we've got in the ASX, what we've got in the US.
I think that's a really good point. It's like, this is kind of that best expressions principle, which is like, if you're going to go for growth, go for the best form of growth. Now, with us, and I assume it's similar to you, is like you kind of have a kind of broad rule from the top down of how much Aussie shares, how much US shares, this, and this. I take your point with some of those tech companies and like the quality falling away. I think that's kind of the mixed bag you get here in Australia, and that's probably why the companies that do well trade at much higher PE ratios and much higher valuations, is because they are scarce, and so people do reward them and are willing to pay more for them. So it kind of has this somewhat of an equalization in the wash. The big risk for me with an ETF like ATEC, and any sort of one that tries to capture technology companies, even FANG, but to a lesser extent, is that you end up with potential companies going missing for other reasons, like buyouts, mergers, these types of things. And it's obviously very prevalent here in Australia. We saw one of the best performing companies in Australia over the past 30 years, which was Altium, that got bought out recently. And that would have been the perfect ETF, perfect holding inside of an ETF like ATEC. So you kind of lose that. I think like, because we blend this with things like VAS and eventually probably have small cap vehicles and stuff in there, I think that overall what we're doing is we're not saying that tech is the be all and end all. It's more just a complement to the existing portfolios. And as you say, kind of diversifying away from just the major household blue chips here in Australia, which aren't growing as much. There was another question which we can jump to now because it makes a lot of sense. This one comes from Jake the Snake. I have it on good authority. I actually saw his birth certificate. That's actually his name, Jake the Snake. Writes in and says, what are the risks of investing?
General advice, I don't remember.
Yeah, general advice only. This is Jake the Snake. This is a real person, but general advice only. Jake the Snake writes in and says, what are the risks of investing in a new ETF like less than 3 years old? Right. And you kind of touched on this, Drew, but did you want to maybe just weigh in on this?
Yeah, I mean, the key here is always when you're investing into an ETF, it's the risk is what you're investing into underneath it. So if you're buying ATech, you're getting tech companies. If you're buying credit, you're getting credit. If you buy whatever it is, the risk is actually in the underlying investments. I think what you're referring to, what Jake the Snake is referring to, is the risk of that company or that ETF not existing. So there's a tendency to think about things going like an ETF goes bankrupt. ETFs can't go bankrupt. They're holding other things on your behalf. Yeah, an ETF provider could. But the risk of owning a new ETF is that the ETF is closed, they don't raise enough money. And in that case, they sell everything down and return it to you. And as you touched on before, that can be a capital gains tax event because they're having to sell all those holdings if they're at a gain and return all that capital. So generally, and this is someone, hopefully we can be, one of the sponsors can prove us or get the real facts on it. But in my experience, probably for a more actively managed ETF, it needs something like 100 million in assets for it to be profitable. So the management fees to offset all the costs associated, both regulatory costs and business and operating costs, to be profitable for the ETF provider. Maybe it's slightly lower, maybe it's between 50 and 100. So if an ETF's not getting there within 3 to 4 years, it's only natural. If you think about a business that has 50 ETFs and one of them's got 4 million and it's not raising any more money, it's costing them a couple $100,000 a year to run, and it's only natural that they'd think about closing that. So that's the risk. But then we see managed funds close down all the time, or their local trusts close down, and all it is they sell the investments and return the capital to shareholders. So yeah, the risk is tax driven more than anything.
Yeah, good point. I know a lot of the Rask community like to do gymnastics, but only the gymnastics that is in a spreadsheet. And if you're interested in calculating this on your ETFs, the way to think about this is some of the big ETF providers have got the running costs of their ETF down to about $100,000 a year at the minimum level. The smaller ETF providers typically have higher costs because they need to pay multiple lawyers to do their PDS to make their compliance work and pay the ASX and so on. And so they're more up around that $300,000 mark. So if you're doing a bit of a calculation on how much does this ETF have inside it invested, multiplied by the fees that are generated by, whatever percentage it is, that will give you a sense of whether you think that ETF is break even or not. So if you are worried about, well, I really like this ETF, it's kind of new, it seems quite popular, it's coming from a big ETF provider, I'm pretty confident that it will get past break even for this particular ETF. But then if you look at ETFs, like the BetaShares A200 ETF, the fees on that ETF are basically zero. So there are some ETF providers where that calculation is just like a moot point because those ETFs are at a point where, from ETF providers at a point where it doesn't really matter. Like they'll just incur the costs and offer a good fund for people to invest in. So there's that. Drew, there was a question here from Larry Loser. That's a fake name. Larry Loser writes in and says, "Hi team, could you shed some light on delisted companies? I've purchased some shares in a company that has been delisted from the ASX. Will I be able to claim this as a loss against a gain on my tax return?" Good question, Larry Loser. We're coming into tax time at June 30th. Drew, what's your thoughts on this?
This is a very tough one too. And I was just going to touch on, so the examples of ETFs that closed last year were very thematic. That was what I was kind of alluding to in the first one. So like metaverse and these kind of narrow thematic ETFs are the ones that kind of failed to get enough traction over a number of years. This one, we don't see this too often, but we do see it enough to know that there are some solutions to it. And this is obviously general advice and information, not general advice, just general information. But what you're talking about is a company that maybe has gone into administration in most cases, as you're saying, they've lost money or has decided not to be listed anymore. If it's decided not to be listed and it's still operating, then you generally can contact the company and talk to them about it. But if it's delisted and it's in administration and it's not to the point of bankruptcy, because there is very specific time periods about when you can realise the loss, and it actually takes much longer than you think in a lot of cases. But there is a website called delisted.com.au. I'm not sure if you've looked at that, Owen, which has a register
in front of me.
Every ASX listed and unlisted company in history. Like I've found Brash's, if anyone remembers the old CD store that existed around Greensboro Plaza in Northland a very long time ago. And then this is one where you can search and find all the information about those companies. But also, interestingly, they have this is again not advice. They have a facility where you can sell or transfer your shareholding to delisted.com.au for a small fee. You pay them to take your shares on, which I'm not sure exactly what they do with it on the other side. But by having a transaction with that share, then you should usually be able to claim the capital loss against it.
Yeah, I've got a screen up here in front of me. The website is obviously, it looks a little bit like it was made before the internet was invented, but
it hasn't changed. The 20 years I've been looking at it hasn't changed.
And it's still so good. That's the thing. That's the catch. It's just so bloody good. But yeah, effectively, like just to understand the tax rules writ large is that you have to realize a capital loss. So you effectively have to dispose of it. Hence why you would sell it to them. You would say, hey, buy this from me. Effectively, you take this. So in effect, you're getting the certainty that you've got a sold price. And they obviously will go and monetize and try to go through the liquidation process and probably have a specialist team to manage that. But delisting itself is not actually, in my understanding of the tax regime, it's just general information, of course, here. My understanding of the tax regime in this instance is that it is not a taxable event because all it's done is delist. A company does not have to have an ASX or, stock market listing to be a viable business. Like Wattle Partners is not on the ASX, Rask is not on the ASX. You're still shares in the companies, right? So just because they're not listed or they list and unlist does not necessarily cause a taxable event. So like a good example of some companies that were on here I just saw were companies like One Page and some old REITs that were like just really, specky companies and whatever. If you're in the situation where you think that your company could do this, to be honest, I mean, I'm the type of person, I would just cut my losses before you get into this kind of admin mess. I would just, if it's a dud investment, just get rid of it. Move on. Put your money in something that will compound over time. Now, we don't know. Every situation's different. It could be like a phoenix from the ashes, but honestly, yeah, cut your losses and just move on, I think is kind of the general gist of that. Okay, so we've got some questions.
Changed over the years as well, which is I used to like try to hold on to everything and maybe there'd be a way to get it out, but now it's the same. Cut your loss. Maybe it's just as you get older, you don't want to deal with as much rubbish. It's just like, cut it, we move on. There's so many other options out there.
Don't get me wrong. I would love to wade into a nice distressed company situation and like actually I'd be really interested in to play that game as an investor and understand, but not in the public markets. You have no insight, no control, no anything on a public company. At least if it was like a private business that you knew was in distress, but you could fix up. Like a very bad example, don't go and do this, everyone, is like a local cafe that you're like, done. These guys are still selling the worst coffee beans imaginable and they're about to go bankrupt. I would buy it and fix it up. Like that's a distressed asset and that's very different to being able to just hold the shares on the ASX. Speaking of which, this actually happened I don't know if you've ever owned a cafe. I know you've owned a bar before, Drew, but there was a cafe not far away from us. Really good branding, really loved the cafe, absolutely diabolical management. And they put out something the other day. I won't say too much more, but they put out something the other day on social media to say, hey, we're closing up shop. If you're interested in the business, let us know. We'll throw you the keys. I was like, well, I mean, I've got enough businesses on the go, but maybe in a year's time, I would probably buy something like that. Like I would probably be like, yeah, sure, whatever. And just see how it goes. But in most distressed debt situations or distressed equity situations, I'm not really interested in playing that game. I'd just rather buy an NVIDIA than waste my time with something like that.
If there's a harder business to run than a financial planning firm, it's a cafe for sure. So if you can...
I'm just a sucker for pain, Drew.
Yeah, exactly.
What question should we go to next, mate?
Oh, damn, Daniel.
I haven't actually read the full instance of this question, but let's get into it. This is from Damn Daniel, who writes in and says, hey, Owen, first off, congrats on the new addition to the family. I'm 42 and just starting to take my finances seriously. That's awesome. Well done. Currently enjoying the Rask road trip and beginning to invest. The Rask road trip is our beginner series of courses. By the way, there's 6 courses put together on our Rask education site, all free, and they link into one another. So it's like the basics of tax, the basic of budgeting, the basics of investing, the basic of behavioral economics, all in like one big, what we call a trip, that you take the road trip and you have a basic understanding of everything. Great work, Daniel. I actually have two questions. The first being in relation to reinvestment plans. I dove in and elected to reinvest, but as I do not have enough money invested, my dividends and distributions are not yet enough to buy new units of the particular share and ETF. Do my dividends accumulate into some sort of pool until I have enough to purchase a new unit? Or am I misunderstanding DRPs completely? Second question is in relation to franking credits. Are they automatically disclosed to the ATO by the broker? Say if I do my tax via MyGov, or am I required to notify them? These are all very, very good questions. So on the second one first, yes, the ATO now has pre-fill across all major ETF providers and most brokers. So you do have to wait a little while for the pre-fill to show up, and it's really good practice to check it, particularly if you have international shares and this type of stuff. So you do get the franking credits automatically added. Thank goodness, because imagine everyone trying to calculate their own franking credits. You can get, like, I always check it. Like, I always make sure that the franking credits are added. Like, you can use Navexa or ShareSite to track your portfolio's tax, and they calculate the franking credits and the dividends and this and that, and you can confirm what's in ATO pre-fill. I would probably do that just in the case that there's something missed or so on and so forth, because you are responsible for what you disclose to the ATO. It's not like in other countries where it's kind of, it's not the self-assessment system like we have here. On the first question, Drew, I know, because do you use dividend reinvestment plans for clients? I don't think you do you?
No, we're heavily against them. Well, not heavily against them. I think when we're investing for both, most of our clients are investing for income and growth, so it's important that we're getting that money come out of some of these investments. But also, we've seen historically, because you can do DRPs not just on stocks but on ETFs and on managed funds as well, that when funds perform exceptionally well, if you do a DRP, you could get a 15% distribution one year, and that can significantly change your asset allocation over a period of time. So we prefer to have cash in the bank, make sure we've got that bucket full, so assessing how much cash our clients need, and then make the decision of where it goes afterwards, as opposed to being forced to buy the same companies every quarter. I think my understanding is that this is how Computershare makes their money, or some of their money.
Yeah, definitely. On the free float they hold on to the dividends before they're paid. They have the DRPs that just kind of exist. I think there's an option, or at least with some of them, that may be donated if the money gets lost or something from the share registries. There's some sort of mechanism in there where the money, you can claim lost money, by the way, guys, as well. But I think there's a mechanism in there where something happens. But the basic gist is that if you look at like an ETF like IVV, which is the very popular S&P 500 like US shares ETF, the reason that was recently did a share split, it was at like $600 a share. So people couldn't use it if they were using DRPs or dividend reinvestment plans, because you would have to get up to $600 for every time it would be reinvested. Otherwise, it wouldn't be reinvested. And so even if you had like $100,000 in there and you got $2,200 of dividends from IVV in a year, there's $200 still left over. So even for bigger balances, it's a problem, not just for smaller balances, which is why the ETF providers like to have smaller share prices as a general gist.
A lot of money that someone else is holding and earning an income off in the meantime, isn't it? But particularly when you're talking about those high unit price ones. But yeah,
you still pay tax on it.
Yeah, you pay tax on it. You still get the franking credit, but basically they're investing or putting that money in cash and earning an income on your behalf until you've got enough to buy that next unit.
Yeah. Damn Daniel did actually follow up, just a bit of housekeeping, did actually follow up with another post and did say that it's probably more suitable for the finance podcast, which is where we tend to do answer the more introductory style questions. But it actually is a good question because we're coming into tax time. For everyone, just as a reminder, DRPs you still pay tax on. Get your tax in order. If you've been investing long enough, like seriously, just go and use one of those tools that I mentioned. Like if you're seeing a financial advisor, they can wrap up all the tax reporting through their platforms and stuff. But if you're using like a CommSec, a SelfWealth, a Perla, a Stake, Bell Direct, any of these platforms, never rely on the tax reporting. But you could probably rely on the Perla tax reporting because it actually integrates with Navexa. But if you don't rely on the brokers, especially if you have investments across multiple different accounts or multiple different brokers, it's almost never accurate. So you want to use one of those third-party tools. I actually do. You were going to answer this question before. I actually do want to answer this question. This question was originally suggested to go on our Australian business podcast. But given that you and I are both business owners, and a lot of people that listen to the show are business owners or thinking of starting business or just love business in general, I figure this is probably a good question to answer, because we do get a lot of this from time to time. Brock Lee writes in and says, I'm looking at starting a business shortly and have a business partner involved. I will be making the jump first, and then my business partner would be looking to jump into the business in 12 months. Keen to hear your thoughts and comments on whether A, this is a recipe for disaster, and B, if not, how could I best treat this? So you obviously have a business partner, Drew. I don't, I've got shareholders, it's a bit different, but in general, how do you think about this?
I mean, I'd be always interested to know why one's starting now, one's starting 12 months from now, and then whether the equity or the investment that each person has made in the business is the same. I think having business partners can be both valuable and challenging. On one side, if you've got a business partner that has the complementary skills to what you do, which my business partner does, then it can be perfect and a great recipe for businesses. But when there's overlap and it's not clear, then there can be, it can be the thing that stops you from growing and being successful as a business as well. I think what you have to learn is basically you need to have conversations at the beginning, and you need to it sounds overly complex, but having basic things like shareholders agreements, or even just like an memorandum of understanding with your business partner, who's responsible for what decisions, how much can you spend without both of you approving, all these kind of basic things you should think about at the beginning. And it just removes and reduces the risk of conflict later on, I think, is incredibly important.
Yeah, definitely. I think that the very fact that Brock Lee's asking this question is probably a good sign that it's not going to be a disaster. A lot of
I thought you were going to go the other way.
Oh yeah, no. Well, maybe it could, but no. But my point is, Brock's going to make the right choice for knowing what he knows about his potential business partner. I would say, as a general rule, though, yes, to your point, these probably go more wrong than right.
Right.
But the reason that happens is people don't approach it like this. They don't have a documented system. They don't have a shareholders agreement. They don't have a buy-sell agreement. So that's where, if a certain event happens, you can buy your partner for X percent or X multiple of revenue or whatever. I think different people can contribute at different times, Brock. And from that, I mean that, you can have partners that inject capital into your business, like money, which you might not have, but you might have the skills and the time. I would just question for you if you want to treat them more as a business partner or a shareholder until such time as they do join the business. So that's a really important thing. To be honest, it is a big commitment starting a business. And if one of the partners is jumping into the business first, the other person might see the first year as the worst year. And so unless they're really contributing their fair share of money or whatever, I've seen a lot of businesses go wrong. In fact, the cafe that I just mentioned actually was one of these, where it was started by mates, and one of them was like, well, I'll do the marketing, I'll put some money in and I'll do the marketing, you do the actual running of the thing. Obviously, that's great for them and terrible for the one that's in the trenches every day, getting up at 5 a.m. to make the coffee. Actually, that was a fatal flaw of this cafe. It's why they didn't be a success, is because they didn't get up early. They would rather sleep in. So I would just say protect yourself legally, have those conversations forthright and upfront now, so it doesn't lead to disappointment in the end. There is some good questions. This next question is actually in a similar vein, but particularly focused on investing, Drew. And this is something that I come across a lot, and it's probably on the back of a story that I said, or we talked about maybe a little while ago on the finance podcast, or even here on the investors podcast. So this question comes from Elon Bust or Boom. This is actually great because I'm listening to the Elon Musk audiobook by Walter Isaacson at the moment. Actually, it's actually fantastic. First off, love the podcast and what you're doing. Yeah, I was actually, the irony of that, I was thinking of hearing his story of getting absolutely ready, because Elon had a pretty rough childhood, it's fair to say, getting beat up and bashed and all these types of things. So it was interesting as I was listening to like how that kind of manifested into what he has ended up doing, which is just remarkable. But Elon bust or boom, they go on to say, I think I love what you're doing. I think I think you'll have never heard one of these before. I think he's trying to say, I'm currently studying financial planning, but wanted to ask because my friends and family don't have an interest in investing. Starting a trust or an investment company so we can all pool our money together and invest. I know there's a lot of admin, but if done in conjunction with a financial planner or accountant, would it be more beneficial? What are the pros and cons? I've been investing for just under 3 years. They say, sorry, it's not so long. So I think I'm going to generalize this question because it may get a bit personally taxi and so on and so forth, Drew. I want to talk to you just generally about like pooling money together to make an investment company. I know many people have done this. It's a good way for friends to catch up. It's a good way for people that are connected to do things together. What do you think of this?
I think there's multiple structures you can do, and friends and family. I'm always, and you'd have to be very careful around the licensing on this too, wouldn't you? As long as it's like a collaborative, which is, I'm sure you can cover that a bit more, that everyone's inputting to it, but someone isn't like leading this investment and raising money for it, if that makes sense, that it would then become like a financial product. And I have to know the legal definition of how you avoid that. Because all we see is financial products mostly. But something like, I think anything that is helping people engage is a positive. I'm assuming you'd probably go along the lines of more of a unit trust structure in this case, in that everyone has a specific entitlement to whatever assets are within there or a company, as these close-end structures that allow you to take a long-term view and hold various assets there on behalf of multiple people. Obviously, most trusts in Australia are discretionary, so the income from a normal trust is distributed at the decision of the trustee. A unit trust pays distributions to each unit owner, and it's unitized, whereas a company has shareholders and you have to pay out a portion of profits, or you don't have to, but you pay out a portion of profits based on dividends. So there's multiple structures to use, but I'm always cognizant of the licensing implications of this sort of question too.
I think the key thing is that around the licensing, so what Drew's referring to, as soon as you start to pull people's money together, it becomes what we call a managed investment scheme under law.
Yeah.
If this is your family that we're talking about, like close family, and you're not making money from it, you're just using it as a way to manage people's money, like for your family unit. I think that's a bit different. I'm not a lawyer, so go and speak to one of those, but yeah, just to double click, there's probably the two preferred structures in this regard would probably be like a company where shares are issued. The problem is if someone wants to leave, they have to sell their shares, and most likely that would have to be sold back to the company in order to pay that person back the value of their shares.
Or to another shareholder, but there's no guarantee.
Or to another shareholder if you've got enough cash to cover them. In the case of a unit trust, effectively what this means is they're like shares, but they're different. They're in the sense you can have a rule that like Gary owns 30%, Drew owns 70%, therefore Drew's going to get 70% of the dividends, and it's all unitized and it's all very clean and structured. Accountants would help you set up both of these entities. And in a trust, you would have a trustee that would set out the rules. In a company, you would have a shareholders agreement. And so you do need to get a little bit admin-y, as you say, with both of these. Most people would be familiar with the property type investing syndicates and people that get together. A lot of people go wrong with those because they don't understand the difference between tenants and common. And what's the other one, Drew? Slipped my mind.
Joint tenants.
Joint tenancy. Yeah. So basically in this, most people, depending on how you define this, right, this is a really interesting thing for people that do want to invest with family members or friends. Like I'm considering doing this type of thing. You don't need to create like formal companies and trusts in order to do this, although a good accountant will help give you the right advice on this. You can, under law, do something along the lines of tenants in common, joint tenancy, and just understanding the difference between the two. The key difference is one of them would mean that if you die, all of the investments that you have in that property go to your co-owner. If you have the other structure, you can set out exactly what percentage of that property is owned by each individual person, so that if they ever decide to sell or the relationships break down, you don't need to sell the entire asset to kind of clear it. You may be able to just be very clear on how much each person owns, what the loan is worth as a percentage, what the debt is, what the property is worth, so on and so forth. So that's a really good thing to keep in mind. As a general rule, though, Drew, I mean, it all comes down to relationships, doesn't it? It all comes down to relationships with this. I think for smaller amounts of money, it's probably fine. But if it gets material, people's lives go in different directions. So maybe it's just like you have an investment group and you each own the shares if you can somehow rally them to do that. Okay, final question comes from Big Dog, which is all about hedging growth alternatives. So Big Dog says, hedging growth alternatives, specifically international property and international infrastructure, assuming an investor with a long-term investment horizon like 20 years, would you generally hedge the currency risk or remain unhedged, acknowledging that over such a long period, the FX or the currency risk is generally neutral based on history? Or take a view on the currency outlook at the time and then flip to hedged, unhedged as exchange rates move. So the question here, Drew, is currency hedging to hedge or not to hedge, but specifically for international property investments and international infrastructure investments. If you're not familiar, you do this via ETFs or managed funds. So most of the time, unless you're like a big dog and you enter your own forward contracts, but you do this via the ETFs or the managed funds that you choose. Oftentimes, it will say in the title of the ETF if it's currency hedged or not. Drew, what is your take on this?
There's tended to be less upside in property and infrastructure, if that makes sense. Like you don't get the 10 baggers generally that you do in traditional share markets. Yeah. And I think the default position on a 20-year time horizon is probably 50-50. Like you actually start with a foot in both camps. You don't want currency, and it can depend on where you're at the time, but rather than trying to make a whole guess at 100% hedged or 100% unhedged, they're actually starting at 50-50 is probably the best place to start. And that's where we would start. Like we use GLIN, GLPR, both are currency hedged. And I think part of like you could compare it to fixed income as well, where the expected returns are lower. So you don't want currency to remove that expected, that potential return, because currency can quickly eat away. Whereas in share markets, you've seen, not expect, global share markets do 30% some years, whereas long-term returns from infrastructure are more like a CPI plus 3 to 4%. So I think the default would be not by going one way or the other, you're taking a big bet. So it's how do you reduce that risk and reduce that bet, and would be starting at a 50-50 position generally.
No, that's a good answer. I think it comes back to what you're investing in that for, right? Like you said, if you're going for multi-baggers, then you maybe take an active decision on currency, right? But if you're not, then if it's going to be like a kind of asset that's somewhat growth, but like they say, somewhat alternatives, maybe the play is a bit of both. If it was a alternative defensive like gold, maybe if you characterize it that way, again, maybe you do the same. But if it's like an alternative defensive that's very different entirely, maybe you consider Bitcoin to be an alternative defensive and you want it to be based in some other thing like USDs in effect, there's some irony in there. So we've got to get a question from you. Actually, no, a question. A dad joke for me. You got a sharp one. Okay. If you did write in a question, more than Holmes and Holes, Big Dog, Damn Daniel, Broccoli, Larry Loser, Elon Musk, Elon Bust or Boom, Jake the Snake. Like if you wrote in, that's great. Jacob also wrote in VUSA or IVV as a less common alternative. IVV is what we hold, Jacob. That's not personal advice, but it's just what we hold, and you can see some literature about that on the Rask websites. Go and check that out, my friend. Just quickly, there was a question. There have been quite a few people write in about some job openings and that sort of stuff. Rask is in the market for anyone with a little bit of experience and a huge amount of passion to join our team, either in like the kind of like what we call associate roles or CSM roles. So this is where I can customer service and that sort of stuff. Customer service, it's not what you think. It's more like relationship management and that sort of stuff, and learning from financial advisors and the modeling team and that. If you are in that camp and you're super talented, reach out. Also, if you're a tax advisor that specializes in investing, I would absolutely, positively love to hear from you. If you do know someone that is, say, like a tax accountant, a registered tax accountant, that absolutely froths investing, that wants to get more holistic in their job, please reach out to me or share this with them, because I would love to hear from them. Looking for super talented people on the tax side of things this year. So please reach out. We've got a lot of people in our community that need good tax, not advice necessarily, like tax accounting, day-to-day PAYG type stuff, but like structuring, investment, tax, that sort of stuff, like a huge amount of interest. Oh, good old Div 7A loan.
Gotta love Div 7A. UPEs.
Gotta love it. Yeah. Tell me more. Talk trust to me, Drew. So just please reach out. We didn't get that many stock questions today. We'd love to get a few more stock questions. There is some interesting things coming up in this reporting season that we're working on behind the scenes here on the Australian Investors Podcast. So there will be some more stock stuff, some more management stuff from ASX listed CEOs and founders and stuff, which is going to be super cool. So stay tuned over the next few months. But Drew from Wattle Partners, people want financial advice, they can head to wattlepartners.com.au or just email drew@wattlepartners.com.au. In the subject line, put in "it depends" and you'll go straight to the top of the list. I'm certain of it. Always. And we'd love to hear from you. You can follow the link in your podcast player for all different types of resources. Drew, what do you got for us?
This one's probably relevant given how far you're driving at the moment. What has 5 toes and isn't your foot? My foot.
Oh my gosh.
Yeah, that was a cracker. I like that one. Credit to me.
Credit to you, good sir. Credit to you. And credit to you.
From the Tesla, but I think
credit to you for not bringing up how well your fake portfolio is doing right now. Based on some pretty elementary mathematics, you are an infinite amount ahead of me, and you're about 2% ahead of the community portfolio. So kudos to you, my friend. Well done.
Yesterday too.
Oh gosh. Bring your questions. Let us know what we're doing right or wrong. We'd love to hear from you next week on the Australian Investors Podcast. If you did get your question on the show today, don't forget you get the Value Investor Program for free. If you've already got the Value Investor Program, you could get some merch from us. Just write into us and say, hey, that was me that asked that question on this day. Or just, hey, I asked that question. Here's my email address. Let us know. We'll shoot you some stuff. Come get a free book, The Golden Years, How to Multi-Bag in Retirement. Out now from Jamie Nemsis and Drew Meredith at most good bookstores or at the Wattle Partners headquarters. So, Drew, absolute pleasure, mate.
Good to see you. Enjoy your trip.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.